right, so this next group is a bit of a power punch, all right? All of them have got big personalities, all right? So before we get them out on stage, I know we just kind of settled in past lunch. I'm going to do a little bit of a stretch routine. You are welcome to join me, no pressure, but usually when you're at a conference like this, that kind of starts to settle in. We need to get the air up a little bit colder. That food is kind of baking in. So I would recommend that everybody take a step up, do a little bit of tree pose. You know, one of these guys. Oh, just give it a stretch. Don't do the starfish, though. You don't want to hit your neighbor, you know? I'll take a little bit of music in the back, guys. Thanks. A little bit of to the side. This is the culturally appropriate time to kind of feel it out just for a quick 30 seconds before you settle back in, especially if you're like in the I'm going to die with this education all day, no networking for me crew. You want to be in this room. You're going to be seated all day. Take the stretch. Take the stretch. All right. So hopefully you guys are appreciating the range of content that we're bringing from the macroeconomists this morning to the risk-adjusted math this afternoon, the LP mindsets that we've had, and now we're going to talk about what are folks doing beyond multifamily. What are the other plays? Every year we get a little bit of a sampling of a different set of people with different investment theories, different investment approaches on stage with a different type of representation. So we're not just all thinking value-add multifamily. And the guy that we have to start this conversation off is the one leading the podcast by the same name, Patel from Beyond Multifamily. I'm going to bring him out before he brings out his guest. Come on out here, Ash. The Beyond Multifamily guy.
How are you guys? How's the best ever conference going? Yes, we've got a great cast for you guys. We've got a great panel, a lot of high energy people, and I want you guys to learn a lot about investing beyond multifamily. So let's bring out our panelists, please. We're going to dive right into this, and before we get started, I want to know from the audience, I don't want to show hands, I want noise. Who here invests in multifamily? Noise. Was that some booze that I heard? All right. Hey, who invests in retail? Let's go. What about industrial? And anybody crazy enough to invest in office? Yes. All right. So we're just going to get right into this. We're going to start with Mike Mangone. Mike is the managing director of Group RMC. I call him the office king. Mike, if you would, give us the definition, your definition of value add.
Yeah, sure. Hi, guys. Well, I think this impacts and is relevant to every single asset class out there. And usually what dictates the pricing of an asset isn't the intrinsic value or what something is really worth. It's the flows of funds, the bidding wars, right? That brings up pricing. So everyone likes to say they're value-add investors, but in order to be truly value-add, you have to find something that is below intrinsic value where the flows of funds aren't. And that would be, and it doesn't matter if you're in multifamily or in office or in stocks or even in bonds.
Do you guys know Tyler Cobble? All right. You cannot get on YouTube and do a search for commercial real estate without seeing his content. Tyler, thank you for being here. If you would, tell the audience a little bit about you.
Yeah, good afternoon, everybody. I always love doing these post-lunch conferences because it's a lot of fun. Everybody's lively. Anyway, I am a commercial real estate broker, investor, developer. I've been doing commercial real estate since 2013, focused largely on value add. But I've done some ground-up development as well, and I'm a generalist. I do a little bit of everything. We've got some self-storage facilities going right now. I'm under construction on a boutique hotel in Nashville. We've got some office. We've got some retail. We've got a lot of industrial. So I kind of run the entire spectrum of commercial real estate.
If anybody listens to the best ever podcast, you know that I don't ask softball questions, right? So we're going to get into some difficult questions. And Tyler, you go first. What's the biggest mistake you've made with social media, and what's your advice to the audience?
That's a great question. The biggest mistake I ever made with social media was hiring a social media management company to take it over. There's a lot of companies out there that will try and tell you, hey, we'll come in, we'll increase your engagement, we'll make sure that you're posting the right things. And to be honest with you, what really drew my audience to me because I got started on Instagram back in like 2016. I was one of the first commercial real estate investors really sharing the journey there. And everybody was following me, for my story, for my takes on things. And so when I handed it over to a social media management company, it completely lost that.
Chris Hatch is the CEO and founder of Forza Commercial. He's got 20 years of experience in commercial real estate. He went from being a tenant rep to a developer. Chris, if you would, share with the audience what you're working on these days.
Yeah, just opened an In-N-Out burger about 3 weeks ago. It's located about 2 miles south of here. So if anybody gets hungry after the pub crawl later, come get me. We'll go Uber down there.
So you're buying lunch tomorrow, right?
Yeah,
For
there you
everyone?
go. It's double doubles. Let's go. But we just opened our 10th Starbucks last week down in St. George, Utah. I've built 5 Dutch Bros. I got 1 under construction, and we have 13 in the design and planning stages right now. So going real hard on the Dutch Bros right now. Yeah, it's me in a nutshell.
Mike, if you would, I want you to blow the audience's mind with ground leases and share what's possible.
All right. So a lot of people don't know what ground leases are, and I'll say, nowadays with the difficult capital economics environment, everyone's trying to find out how to, get a better deal. And I think we have to go a little bit further than buying what you can today for 80 cents that you could have bought, a year ago for $1. It's all in creating structures that tilt the favor towards investors, either by giving better returns or lowering the risk. The British monarchy owns half of the land in London. And what they do is they just collect a royalty payment off of all the buildings on top of their land. McDonald's does this. The Vatican Church is probably the biggest to do this. Right now, there's a group of developers and people who they either have the choice of getting some kind of predatory mezz loan at 15% or borrowing very expensive. By the way, we're getting close to credit card interest rates. We're talking about this before. Or we knock on the door and say, look, we'll give you $20 million, but we'd like to buy the land underneath your building. And now all of a sudden we have what every investor, I think, or most investors are looking for. We have a hard asset, land, uncorrelated to markets, income producing because we collect rent from the building on top of us. In that contract, which is 99 years, so forget 1 year, 10-year, 20-year leases, this is a 99-year lease. It's inflation adjusted. There's no other lease out there that's inflation adjusted like that. And people who own the land are senior to the first mortgage and the equity of the building on top. And if you're familiar with mining royalties or pharma royalties, well, this is a real estate royalty. The income comes from top-line revenues, not bottom-line profits after paying your revenues minus your expenses, whatever little crumbs you have left can pay a little distribution. This is the first rank in revenue. So hard asset, uncorrelated markets, first rank, most senior, income producing, inflation adjusted. And so we're very excited about that.
This is a question that any of you can answer, but we hear a lot about AI, right? It seems like everyone has it on their resume. When you invest with somebody, we use AI for this and that. Do you guys have a good example of how AI has really helped your business?
I've been, go ahead, please.
Well, I was just going to say, whenever we're putting offering memorandums together to go raise capital, the thing that I've found that works the best is to prime ChatGPT to tell stories, and then I'll have it interview me. And so I'll just sit there on my phone doing voice to text, answering all of its questions, and then it'll typically ask me another round of clarifying questions, and then it writes it all out. And it's really cool because it'll basically use some of the phrasing that I use too. And it makes it so much easier. We can crank out offering memorandums in a single day now.
We use it just anytime we're replacing bulk text, right? It's just so much faster, so much easier. It's like the easiest resource to use for that. We haven't really implemented it much on the site selection side. I'm a firm believer you got to put the dirt in your hand. So,
yeah, I've always been apprehensive of using AI. I'm like a self-deprecating millennial on this sense, but for me, it really blew my mind. As much as I've been resisting it, it replaced Google for me. I use it as my search engine. So instead of asking Google a question and then having to filter through a bunch of websites, I ask ChatGPT a question and it gives me an answer. And I think it saves me time from that perspective.
Chris, you got everyone's attention with that In-N-Out burger that you threw out there. But what makes a great site? You're focused on drive-throughs, right? Right now?
Yes.
What makes a great site for a drive-through retailer?
You know, it just depends on who it is. So let's take Starbucks, for example. A typical Starbucks needs to get located on the AM side of the road. So how do you tell which side of the road is the AM? You go sit at the intersection where your site is, and you count cars. And you do that sometime between 8 and 9:30 a.m., or you do it between 4:30 and 6 p.m. And depending on which side of the road has more traffic, that's going to tell you where the AM side of the road is. And so if your site is on the morning side and it's really easy to get into, and you're located 1.5 miles or 2 miles apart from another Starbucks, you highly likely have a Starbucks location. And so it just kind of depends on each retailer. The burger folks, like In-N-Out, they're, that's more of a regional play. And so what was interesting, when they chose to initially come into the state of Utah 12 years ago, they started in St. George, and then they expanded up northward into the Salt Lake market, and they never came into the capital city of Salt Lake. And we actually have very preventative zoning for new drive-throughs in Salt Lake City. And so where I located them was right on the border of Salt Lake City and South Salt Lake City, in South Salt Lake City, and it just happened to be at the cross of I-80 and I-15. So it's kind of like the perfect bullseye for where they would want a regional location.
Folks, we've had a lot of economic uncertainty lately, and anybody that's been in commercial real estate investments for many years, you would do fine just with sticking with the one asset that you're focused on, right? And I hear this a lot from people: be hyper-focused, stick to what you know, deep dive on what you know. These three gentlemen up here, over their careers, have pivoted into different asset classes. So if you would, I'd like you to share some advice for the audience on why they should look at other asset classes.
2 years ago, we decided to take our show on the road, and we decided we would go basically anywhere a national retailer wanted us to go. And that felt like pivoting asset classes, because all of a sudden we were looking at the U.S. I cannot believe the amount of opportunities have opened the moment that we adjusted ourselves to thinking that way. Prior to that, we were kind of a mountain and desert states developer. And I now can speak with command on most of the major 50 trade areas in the U.S. As to where the top fast food restaurant is, and basically all of those. And it's just opened up relationships, et cetera, and helped to diversify, right?
Being a single asset class investor is crazy to me. I really don't understand it, right? I mean, if you're only investing in single family, or if you're only investing in multifamily, I mean, my question to you is why? Right? I mean, if you're going to start investing in the stock market, you're not going to go all in on Apple, right? You're going to go diversify through different types of stocks, and you should be doing the same thing in real estate, really. 80% of every asset class is the exact same. And when you learn one other asset class, it starts to open your thinking as to how you, and the other things that you can apply to something else. So for example, I bought a 6-bay car wash in Nashville that was old, run down, all of the equipment needed to be replaced. The land was so valuable that it made no sense as a car wash. So every investor looking at it said, well, I can't afford to spend $412,000 to buy this lot, a couple $100,000 on equipment, only to make X, right? I didn't even look at it as a car wash. We looked at it as an outdoor food hall. It was 5 micro restaurants and a bar, so 240 square feet each or whatever. And when I looked at it from that perspective, the numbers soared, right? It made all the sense in the world. And I wouldn't have been able to do that if I was thinking myopically from a car wash perspective. So it just opens up the possibilities of what you can actually buy and take advantage of in the market.
I like that. So you're saying you put a real estate layer over everything you look at, right? Because everything has a cap rate.
That's right. Everything's got a cap rate.
Everything has a cap rate. So it's interesting. We've always been deep value investors, and again, like I was saying before, most people like to say they're deep value, but because if they're not saying they're deep value, then they're admitting to overpaying for a lot of assets. But in order to be deep value, you really need to be flexible, and you have to have some courage. And if, back to the first lesson, if what dictates the pricing of an asset is flows of funds, and if you want to get something below the intrinsic value, then you need to go where there's no flows of funds, and that can change. We've done it. In the 80s, during the S&L crisis in Texas, it was multifamily. You're buying that for $15,000, collecting $5,000 a year in rent, and it was the end of the world in the newspapers. In the 90s, where I'm from Montreal and Quebec, we almost had our own Brexit. We almost split from the rest of Canada, and that's when we knew not everyone was going to move to Toronto. So we started buying in a politically unstable environment and did very well at 20 cents on the dollar. In 2008, I'm trying to become American, right? So I moved here 2 years ago from Canada, and I remember, Americans tend to be down on themselves when things go wrong and are a little bit difficult. But don't forget that this is the greatest country on earth. This is the American miracle. And in 2008, people forgot that people said that the USD was going to be dead, and it was going down. It's not true. Look what happened. And so from a Canadian's lens, we came in and we started buying office. We became some of the largest landlords in a lot of cities in the United States: Kansas, Columbus, the third in the suburbs of Chicago. And then in the pandemic, well, the world changed again. So of course your thesis needs to change again. You can't just be doing the same old thing. So we started entering gateway markets because we couldn't believe the kind of assets we were getting at 20% on the dollar. Then ground leases, and then we started buying leases. It's what generates all the economics in a building. When you look at a building, it's not just land in a building where you can bifurcate everything. You can split it up. There's the building on the land is one thing. The land on the building, under the building, is another thing. That's a ground lease. But in the building, what generates all the economics are the lease contracts. There's a way to buy leases, by the way. And so you add a real estate lens on everything you do. We even bought restaurants that way. And everything has a cap rate, and everything falls into your model, but we have a different perspective.
Mike, you mentioned that Group RMC was one of the biggest landlords in a lot of Midwestern cities. So you're dealing with institutional assets. I'm going to ask you a question. If you had $50,000 left, what would you do to build back up again?
Well, I actually hate the expression, but you're only as good as your last deal. And I'm a CPA by trade, so I'm very risk averse. So I would just, increase my time horizon and go for the singles and doubles, right? Because the power of compounding is the eighth wonder of the world, right? 1 buys 2, 2 buys 4, 4 buys 8, 8 buys 16, 16 buys 32. You pass away, your kids inherit daddy's 32 properties, whatever they are, and then it's 64. You can't slow that down, and that's how old money is created. And so I would extend my time horizon, go for the singles and doubles, and just buy a really good asset at a really good price in a really good market. And it's easier said than done. So be patient to find it.
The asset classes that we all invest in, there's no real playbook, right? There's tons of books written on multifamily. There's YouTube videos, there's courses and masterminds for multifamily. But for us, every deal is so different from the last, right? Every lease is completely different. What's an example from all three of you where creativity won in either capturing a deal or adding a lot of value to a deal?
We bought an office building in June of 2019. I finished my renovations in January of 2020. And what happened a couple months later? All right, everybody thinks that office was terrible. We signed 16 leases, and I flipped that building in October of 2020 for $450,000 in profit. So the thing that we did differently on that building was that I knew going into it, the neighborhood that we were operating in was mostly small businesses. That's who wanted to lease space there. So we bought a 12,000 square foot, 2-story office building. It had one 6,000 square foot office upstairs. Nobody wants that anymore. This was even back in 2019. I was saying nobody wants that anymore. And we carved it up into little 250 to 500 square foot executive offices with shared restrooms and a shared kitchen and crushed it. I don't think that we've ever had another property that we've signed that many leases that quickly on, especially considering the fact that it was in the height of the pandemic. So just thinking a little bit outside of the box, and we didn't even change the use, still office space. We just looked at it differently.
Chris or Mike? Yeah, please.
My world's not that creative on the building side. If you've been in a Burger King, it looks the same wherever you are in America. However, I started in 2002 as a tenant rep broker, and for 20 years I chased tenants. And then 2 years ago, I started this journey on social media on X and LinkedIn. And then I added a podcast in December, so I'm up to episode 9 on that, where I only interview retailers. And by putting out information about what I do for a living, I now have CEOs, CDOs, heads of real estate all finding me. And so I just flipped it around.
Tyler and Mike, you guys have invested a lot in office, and multifamily used to be the elephant in the room. Now it's office. Nobody is investing in office. Why should our audience start looking into making investments in small offices?
Well, it always goes back to flows of funds. Where there are no flows of funds, and there's reasons for that, you can get below intrinsic value. And like Warren Buffett would say, it's hard to go wrong when you buy a dollar for less than a dollar. It's very simple. Of course, stay away from value traps, and I mean, that's a very broad thing to say, but there are value traps if you're chasing value too much, but we never buy empties. We let someone else be a hero. Empties actually lose money, and so at one point an asset becomes a liability if it's losing money. So the idea is buy a filet mignon for chicken prices and go into a moment where you need a little bit of courage. You gotta be a little bit of a crazy person, and that's okay. Being a contrarian, just for the sake of contrarian, is not okay. But being a contrarian because you're seeing, look guys, we bought buildings, or we're buying buildings right now for $100 a square foot. That would easily cost $500 a square foot to build. And once you build that building, it's empty. To lease a building costs easily between $30 and $60 per square foot, and time. So, you know, it's just, if you have the time on your hand and the asset isn't losing money, so you actually lower your bases every year, then you'll be fine, and it'll be a no-brainer in a few years.
Retail was on the chopping block a decade ago. Nobody is saying, are you worried about retail today? Often, the big thing with retail is that it evolved. It had to evolve to fit new consumer habits. That's what office has to do, right? And that's what it has been doing for the past few years. We are now 5 years out from the pandemic, which means that every single lease, not every single, the majority of leases that were signed before the pandemic have now run through. If we were going to see an absolute travesty in the office market, it would be happening now, and it hasn't. And that, to me, says everything that you need to know about office. It's just changing. That's it. And it's on sale, so go buy.
What kills a lot of smart people is debt. It's what also can make some people rich. So I think that going in with I agree with everything you said, going in, but in a cap stack that is a lot more secure, less risky, is game changer. Another popular saying, and I love it so much, it's usually cash is a lot like oxygen. You don't think about it until you run out, and then it's all you think about. So you got to go in with a lot of cash. And in good times, people are saying, well, that's a killer of IRR. Because what is the killer of IRR? Well, it's cash. The more money you have in something, the lower your IRR. And time. The longer you have something, well, the drag on the IRR is bigger. That's okay, because cash is a lot like oxygen. And people who had a lot of cash going into the pandemic as interest rates rose 11 times did all right. It stung, but they're still around, and they're actually still buying. So leave money on the table. Go for singles and doubles. And when the capital markets comes back, the flows of funds will come back, your valuations will come back, and then it might be time to start ticking up on some LTV and get all your money out, which, by the way, when you refinance, it's a tax-free event.
We could go on a complete tangent on this, but kind of to what you're saying, I think the IRR for the majority of investors out there is a garbage investment return metric. It doesn't mean anything to the majority of you. And it is also the most manipulatable investment metric that you can track. You can't manipulate cash on cash in your equity multiple, and that to me is what matters. And so if you're out there pitching capital and raising from investors, explain that to them today. Yes, your IRR is going to be lower. Here's why that's a better risk-adjusted return today.
I agree. I wish we would just eradicate IRR from all these pitches and OMs. So the takeaway on office, and folks, we're not talking about city center, urban core office buildings, right? We're talking about office buildings in walkable suburbs where your tenants can walk to the bars and restaurants and shops. So look for those deals that pencil out. They make money. There's vacancy for upside. While you're in due diligence, do some advertisement. See what kind of demand you have for single, double, triple, small office space, right? Has this inspired anybody to start looking at office? Anyone? Good. Good. We're doing our job well. We talk about a lot of the wins and how much money you make in commercial real estate. And again, my definition of commercial real estate is non-residential, so not multifamily. But let's talk about some tenant nightmare stories. Who's got one that they can share? We all do, but who wants to share it?
I'll jump in. I feel like about 3 or 4 years ago, it became cool at cocktail parties to talk about prefab construction, right? Anybody in here tried prefab construction? Okay, I'm the only psycho. Awesome. So Dutch Bros got in with a group and said, look, you need to build a few of these buildings with this. And I said, okay, I'm really apprehensive. It just seems really crazy and wild. And what they didn't explain is that you need a second set of architects. You need a local GC who's pissed at you the whole time because their GC bill is way smaller than it should be locally. It's going to be a nightmare because you got to get the thing approved at a state level. And so you got to go through that, and then you submit the plans to the city. They're stamped by the Department of Housing at the state, and then the city comments on them, and you're like, no, you're actually not allowed to comment on them. That actually comes from the Department of Housing. We just need your comments on the site plan. And then you get in an argument with the city people for 3 months, and so you kind of get a feel for how awesome it is to build prefab. If anybody wants to build prefab, find me after, and I'll talk you out of it. We did 3 of them, by the way. I hated all 3 of them.
Yeah, I mean, it's the same as the shipping containers. It doesn't work. As soon as you penetrate those walls, you've completely made it not structurally insufficient. We had a deal that I bought back in 2020, signed a lease with an upstart catering company. They were smaller. She was moving into a bigger space. She gets into it, never builds it out, is paying me rent because that's what our lease states, never moves forward with the deal, runs out of money, stops paying me, and then sues me because she couldn't pay her rent. Let that sink in. I know how ridiculous that sounds. So we spent 2 years in a lawsuit because she had a wealthy grandfather who was a co-signer on that lease, who she was not telling the truth to until we went through full discovery, full mediation, cost me about $120,000. But it was still, I mean, we still made a few $100,000. So
We're going through the exact same thing right now.
it's ridiculous.
Yeah. We've covered office. I want to get to retail, but first, is there an asset class that's overhyped right now?
Are you asking us to talk about multifamily right now?
Well, sorry, let me rephrase the question. Is there an asset class besides multifamily that's overhyped right now?
Maybe self-storage. You know, I mean, I think a lot of people are thinking, oh, self-storage is hot. It's the next multifamily apartment complex. You don't have to deal with tenant issues. Let's jump into it. And I think that's true. Like in a lot of ways, like there is a reason that self-storage is so great. It's getting overbuilt in a lot of markets. Pay attention to the fundamentals because you could really lose your shirt on that.
Ash, what do you think?
Flex is overhyped. It's essentially large self-storage. That's what flex is, right? And it's gotten very easy and very cheap to build flex. Everyone's doing it, and there's a lot of markets where it's already oversaturated. Your thoughts?
Easy to build and quite expensive right now, and you can build it anywhere, right?
Yeah.
Yeah, I would see that. I agree.
All right, so let's go into retail. You know, the Wall Street Journal called retail the best kept secret in real estate. And there's a reason for that. Can you guys share on why that is?
Yeah, just back to the point, right? Tyler was saying how retail evolved. It's nice, by the way, the Wall Street Journal is telling the truth this time on that article. That was a really bad time period 10 years ago when every periodical like Wall Street Journal was basically announcing the death of retail. What was fascinating during that entire time period is I spent a lot of time sitting in a car behind a windshield next to a retailer, and you just weren't hearing anything, what you would read in the press from the retailer. In fact, it was the opposite. It was, hey, you know, things are going really well, and it's a whole new world out there. Retail has evolved so rapidly over the last 10, 12 years. Let me give you an example. If you have lived in a household from like 1995 to 2005, and you had any women in your household, and they consumed any product from Victoria's Secret, then you remember that you used to receive like 3 to 17 catalogs per week at your household, right? Does everybody remember this?
Or if you're a college kid.
Or if you're a college kid. Yeah, that's right. Yeah, or if you're a college kid. If you live in a household with women that still consume Victoria's Secret products, ask yourself, when is the last time you saw a catalog? You haven't. Retail adapted to content being marketing so quickly and led the charge, and that's what you've seen. And so that's one of the adaptations we've watched, and it's causing sales to absolutely just surge. The other thing you're seeing is that they've turned the brick and mortar. You hear a lot about last mile if you go to industrial conferences and get out to the consumer. Retailers have changed their store footprints, and they're all like basically mini UPS stores. That's what they do. It's all it's the click and ship from there. So when you order something from Nordstrom and you're located in, I don't know, Murray, Utah, right here, and they don't have it, but the store in Bellingham, Washington does, they put it in a box in Bellingham and they ship it right out of that store.
Yeah, to elaborate a little bit more on that. So right now, retail vacancy is the lowest it's been in recorded history, right? The clickbait headlines that you see, Rite Aid, bankrupt, Big Lots, bankrupt, J.C. Penney, after 120 years, they survived World War and the Great Depression, and COVID got them, right? Bankrupt. All these big box stores, Sears, Kmart, the list goes on. But you know, if you take out your phone and search for store openings and numbers, you'll see Dollar General's opening 800, Aldi 160. The list goes on and on, right? So, sorry, Tyler, go ahead if you would. Talk to the audience about why they should consider investing in retail.
Yeah, I mean, I was actually going to take the opposite approach and be a little contrarian here. I mean, I love retail. I own a lot of retail. But, I mean, if we're going to
He doesn't want you guys to compete with him, that's why.
That's right. Go invest in something else. I ruined flex space and industrial outdoor storage because of YouTube, so y'all go do something else. Whenever headlines just start repeating the same mantra over and over and over again, I'm like, all right, there's either an opportunity there. What is the opportunity there? Everybody says office is dead. Cool. Everybody's going to be afraid to buy office. Let's go buy it. If everybody suddenly starts saying retail is the darling of commercial real estate and occupancy is super high, that's great if you're already a retail owner. That may not be the best situation for you as a retail buyer because you might be paying a super low cap rate with a really high NOI, and there's a chance that your occupancy could go down. That being said, value add retail, huge fan. If you can go find a shopping center 60 to 80% occupied, especially if it's like Class B, Class C, grocery anchored, oh my gosh, buy it all day.
Here's the counterpoint to your counterpoint. You ready? Okay, so you said occupancy might go down. So think of it not in terms of macro. Everybody think in your head where the shopping center is located, where you shop. And then think of your trade area, your home trade area. What has been built new that's retail in the last 10 years? And that's the counterpoint to the counterpoint. Yeah. There's like nothing that's been built. Nothing of size. I just left I went to a retail broker conference. It's called the X Team Network. It was 2 weeks ago. I was in San Diego. So I'm in a room with 250 people. All they do is represent national retailers. They're salivating talking about these bankruptcies that are coming through because finally they have space for their retailers.
Yeah, I mean, we've got guys that are already working on the Joann's deals. I mean, it is a very hot market. And to that point, like most of the retail that has been developed is all on the bottom floor of mixed-use buildings. It's the same story we were talking about with flex space. Right, all these industrial developers started doing, million square foot plus distribution centers, stopped paying attention to flex. Flex got torn down, and it's the same thing on retail now. There's not a lot of it being built.
Things are never quite as good or quite as bad as you read in the news, right? It's a lot of clickbait. And if you look at Simon Properties, and it's a public company, right? If you read all the Wall Street Journal articles of death of retail, until about 2 years ago, they were just skyrocketing throughout the whole death of retail story. So completely different than the narrative. So there's a lot of nuance in all this. I like, for example, lifestyle centers where you can take this on Amazon. Like there's beautiful retail being built where I live, and you have a hairdresser, you have a yoga studio, you have a Pilates studio, you have a bar, and it's just really cool, and I want to hang out there, and it's next to a car wash. I don't see that ever going away, and it's doing very well. Parking lot's full.
So along the same lines of looking for office building in your favorite suburbs or where you live, I would encourage you to look at where do you go for the pizza place, the deli, the dog groomer, the optometrist, right? Those small mom and pop strip centers, try to underwrite them and see what kind of cash on cash they're kicking off. Have we inspired anybody here that wasn't inspired before to start looking at retail? Thank you. We've got a few minutes left, and this is something I'm pretty passionate about, and you guys might roast me for this, but there's a lot of social media influencers. Everybody's talking about buying a business, right? Oh, let's buy a business and scale it and make a ridiculous amount of money. My opinion is that when multifamily started getting difficult, people started pivoting, right? They went into self-storage, mobile home parks. Then they got into buying laundromats. Remember that? Laundromats were 12 caps, now they're 4 caps. Then they started buying car washes. I advise people against buying a business unless you absolutely know what you're getting into. You have the ability for this investment to become a full-time job if one of your key people leaves, if your sales go down, if the culture of this business that you bought changes, right? I want to hear your guys' thoughts on if people should be buying businesses and if you all are buying businesses.
Absolutely not.
Good.
I mean, I didn't get into real estate to buy myself another job. So I 100% agree with that sentiment. Buy the building, rent it out to the tenant, let them deal with it.
So 90% of my net worth is in real estate. So, we have to diversify a little bit on that too. So the other 10%, what do we do with it? We have something called RMCPI, or RMC is my company. It's RMC Principal Investments. And in that, a lot of family offices co-invest with us on the real estate side, but they're able to do that and become family offices because they're quite successful in their industries. And so all of a sudden, we like to know what they're doing on their side and how they became successful. And so we start getting deal flow. And so from there, again, you put on a real estate lens, you put everything as a cap rate, right? We started looking at really interesting things like medium-term Airbnbs in Europe, or equipment financing, which can have a lot of depreciation. Or we even we invested into a Michelin star company, a restaurant before it won the Michelin star, and now we're expanding it. But this is all through access. As you create a co-investment group, we're in a very privileged and humbly speaking, very lucky position to be able to see a lot of different deal flow.
We currently are evaluating looking at multiple restaurant chains. But we have not to date.
And would you be part of the operations?
Yes.
Okay.
If we were going to do it, we would probably do something to the scale of 100 to 200 stores out of the gate, and then look to grow it to 500 to 1,000 through franchise growth or through going public.
Chris, your advice to a young person who sees a lot of social media superstars that brag about buying businesses and how much money they could potentially make?
Proceed so cautiously. I'm 22 years in. I've never even thought about being on the business side till the last year. Some of the retail cycle has evolved, and so you can make a business case for why that might make sense. Back to both of your points, you then end up owning an operating business, which means if your operating partner doesn't come to the table and do the job, hi, you're now the operator. Have fun.
Folks, we've got about a minute left. The 4 of us are going to be next door. We'd love to see you. Any questions that you have. And for the rest of your time at the Best Ever Conference, please walk up to any or all of us. Sit down at lunch with us. We'd love to talk to you. It's the whole reason we're here, right? It's not to hang out with each other. We want to hang out with you guys. We want to interact with you, share some of our knowledge, our failures. We have a minute left. I'm going to ask the 3 panelists if they have any questions for each other. Hard questions.
I've got a good one. If you had to invest your life savings into one deal, what makes it a hell yes?
I gotta love the brand and love the real estate, both, for me. Serious pride of ownership.
Seniority on the cap structure.
Tyler, I'm going to ask you, what are the top 3 things that you look at when underwriting a deal? The top 3 metrics, and it doesn't have to be a monetary metric, but just the 3 things that you look at that have to appeal to you.
First thing is price per square foot, right? Like if we have to look at this from a replacement cost perspective, what does that look like? Followed by the rents compared to what I think that the market rent's going to be. And then the operating expenses. I mean, it's really straightforward, right? But those are the 3 things that you can have the most control over, in my opinion, when you're buying a property. So that's the best thing to look at.
Folks, please give it up for this panelist. Great job, guys. Hey, our goal was to really inspire you to look beyond multifamily, right? So please come see us. We're next door now. Come see us at any time.